And so there, what he's basically saying is that, look, if the United States is if the United States is going to supply the currency to the rest of the world, they effectively have to run trade deficits with the rest of the world, because the way to think about it is that the only way for the rest of the world to get dollars is either to acquire them through trade or through foreign exchange markets, right? Because they can't produce those dollars. And so his kind of fundamental point is that if you're going to, if the rest of the world is going to use dollars as the primary currency that's used in trade, then that means we have to be a net exporter of dollars. We have to provide those dollars to the rest of the world. And so that means that, that corresponds with trade deficits. And so a lot of people in the economics profession will say, well, that's not like really a big deal. Like we're providing dollars to the rest of the world. They're providing us goods, like that, that's the trade, right?
Welcome to the Benson Wealth Podcast. I take complex financial and economic topics and make it accessible to the everyday listener. Hello, everyone, and welcome back to the Benson Wealth Podcast. My name is Drew Benson. I am the president and founder of Benson Wealth Management and a senior wealth advisor with Raymond James. I'm also the co-managing partner for True North Wealth Management Group, which is a platform for independent wealth advisors. Hey, if you're out there and you work for one of the big firms, if you are a captive financial advisor and you're a W-2 employee, and if you've always wanted to make the jump to the independent side, but you just haven't had the courage to do so, we may be a great fit for you. My business partner, Jason Nero, and I, we worked at a big firm and we made the transition. We know what it's like to move from point A to point B. We've walked in your shoes before. If you're looking to do that with the least amount of friction, with the greatest amount of success, we may be a great fit for you. So if you have any interest, please reach out to us at True North Wealth Management Group. Okay, so today I had this is a very interesting conversation. Maybe one of my favorite conversations I've had to date. It was with a professor at the University of Mississippi, Josh Hendrickson. Josh is the department chair there for economics. He holds a PhD in economics, and his research interests, his specialties are monetary theory, monetary history, and political economy. It's interesting because when we got into this discussion today, I actually envisioned a longer dialogue about monetary policy because he writes pretty extensively about Fed policy. He is going to come back on. I already cornered him after the interview and said, I want you to come back because he was so great today. We're probably going to get him on early in 2026 to come back and talk to us about the Fed and monetary policy. But actually, today's interview was particularly relevant and fascinating, and he brought up some ideas about trade policy and the Trump administration that, frankly, I'd never really considered before. And I will say this, prior individuals that I've interviewed regarding trade, which have been very good, have been more around the idea of whether trade is good or trade is bad. And when I say trade is good or bad, I guess what I really mean is whether tariffs are good or trade barriers are good or not. Josh didn't come in today to make an analysis on whether the policies of the White House were good or bad, or whether we should be free trade or non-free trade. And I think fundamentally, Josh is a free trade, free market kind of guy. Josh really wanted to understand, and his research has tried to really unpack, why is the administration actually doing what they're doing? And I will say, my biggest takeaway from this conversation is that I believe, and I'll admit this, that I had some misconceptions around why the administration was doing the tariff policy or the trade policy the way they were. And I'm not saying everything I thought about it was wrong, but I think there was some deeper contextualization and deeper context to the why. Why is the administration engaging in trade policy the way they are? And it's a lot more dynamic and complex than just this, I want to bring manufacturing back to the United States. There's a whole financial component. The national debt gets tied into it. And there's this 40-page paper that was written by a member of Trump's administration, Stephen Miran, on a deeper philosophy of why they're engaging in these trade policies. And again, the goal of this conversation isn't to tell you whether you should agree with this policy or not. The goal of the conversation is for us to have an objective intellectual understanding of the nature of the Trump administration policies, so that therefore we can actually make very rational decisions moving into the future. And I think the mistake we can make, if you work in finance or you run a business or you're an academic, the mistake that we can make is if we make assumptions about the reasons behind a policy and those are false reasons, our projection of the future is going to be extremely clouded. So what I appreciate about this conversation, and the reason I feel like my axe is sharper after this is why I do this, by the way. This is why I interview people like Josh, is so that I'm talking to people with great ideas and I come out as a better business person and as a better wealth advisor. But if I can go in and actually understand the deeper reasons of why the Trump administration is actually engaging in trade policy, then I can make a more thoughtful idea or have a thoughtful forecast into the future of what it could lead to. And at the end of the conversation, we do get into kind of practically what does this mean for the marketplace, et cetera. So I really love this conversation, really grateful to Josh, and I hope you enjoy as much as I did. Josh, thanks for coming on the podcast today. Good to see you.
Yeah, happy to be here.
So let's get into monetary policy today and talk about trade policy, Donald Trump's policies. There's kind of a lot to digest today. So I'm looking forward to unpacking some of these ideas with you. So let's talk about tariff policy and just the disruption that we're seeing with trade, and what I think what some are describing as a bit of a reneging on trade policy from the Trump administration. What do you think the ultimate end game is for the Trump administration and tariffs?
Yeah, so I think that essentially what they're doing are things that they had kind of outlined prior to the administration. So the people that he appointed to positions like Scott Bessent, like Stephen Miran, like they actually outlined kind of like their vision of like where the United States needed to go. And Trump's appointment of these guys suggests to me that, you know, what they were saying before Trump was elected is indicative of where the administration did indeed want to go. So I think one important thing to do is to kind of try to figure out what they're doing. I think one of my frustrations kind of in observing what's happening is that sometimes we kind of blur the line between what are they doing and why, and should they be doing it, right? And those are two separate questions. Mm-hmm. And so whether you think that they should be doing it or not, you need to understand why they're doing it. Because if you understand why they're doing it, you might have a better sense of, you know, the durability of these policies, or whether they'll actually stick with them, or whether these are temporary or et cetera. And the should they do it is a separate kind of question. I think in terms of why they're doing it, Stephen Miran wrote a paper when he was still at Hudson Bay Capital back in 2024, and he basically speculated on like what he thought the Trump administration's policies would be with regards to trade and with regards to tariffs, with regards to the dollar. And he basically outlined this idea, which is basically that there are challenges for the U.S. of having the global reserve currency, and that those challenges are things that when U.S. debt levels are really low aren't necessarily an issue. But when debt levels get really high, this now starts to become an issue. And that if we don't do something about it, then we're risking, you know, significant economic costs. And so in particular, I mean, what he's really talking about is that, you know, I guess the best analogy to give is if you think about like the world under the gold standard, central banks under the gold standard around the world, what they're holding in reserve was gold, right? If they needed to settle payments with one another, they're sending gold back and forth. The world that we live in now is kind of this weird world in which what central banks, you know, hold as reserves are U.S. government debt. And so this kind of creates a problem for the U.S. You know, when debt levels are low, this is great because it allows you to a lot of flexibility, right? So the United States can borrow more than it normally would be able to borrow or something like that because there's just this passive demand for U.S. government debt that's coming from these central banks. Like this is just what they hold, like as a temporary, as a temporary way of earning some interest to then convert those to dollars later when they actually have to settle payments and things like that. But when debt levels are high, this is potentially a problem. And the reason it's a problem is like as the rest of the world is growing, there's just going to be an increase in the demand for money as they grow. And that means that there's also going to be an increase in the demand for reserves, which means that there's going to be an increase in the demand for U.S. government debt. And so if you think about two scenarios, if the United States is really frugal and it doesn't supply the debt to the rest of the world that it wants, this is going to tend to push interest rates down, but sort of artificially so, right? Like this isn't reflecting people's like borrowing preferences or something like that. It's not reflecting their rate of time preference. It's reflecting the fact that there's just not enough of these bonds out there in existence, which is pushing these rates down. But if they do supply that debt to the rest of the world that the rest of the world wants, if the rest of the world's growing faster than the United States, then just as a matter of arithmetic, like the debt is going to be growing faster than U.S. GDP. And so that puts our debt on an unsustainable path. And I think those are the things that, I think that's the fundamental thing that Stephen Miran is talking about in that paper is that, look, when debt levels are really low, it doesn't matter if we're technically on an unsustainable path because the level of debt is so low that eventually, we can right the ship and it won't cause these problems. But when debt levels are really high and you get on that unsustainable path, the system itself can actually break down, right? If people lose confidence in the U.S. ability to pay back that debt, then, you can end up with some really severe consequences for both the United States government and for the dollar.
So when you say, so you're just saying that these nations are demanding U.S. treasuries, right?
Correct. Yeah.
So they want more U.S. treasuries, which means we are borrowing more from foreign nations, which is driving interest rates artificially down, it's driving our national debt up. So yeah, this seems like a really bad set of incentives for the United States, and it's put us on an unsustainable path. So what is Stephen Miran's then solution to all this? Because it seems like is this the theory that he's laying out? Is that what you're saying, Josh?
Yeah. So this is kind of his idea. And then his other idea is that, so I don't think that argument that I just mentioned is, I think it's actually a pretty conventional argument among like international monetary theorists. Like there's, there are some like academic papers in top journals where people are making this argument. So it's not like this is some kind of fringe idea. I think the more controversial argument that he makes is with respect to how this also influences trade. And so what he's basically saying is that, look, if the United States is going to supply the currency to the rest of the world, they effectively have to run, trade deficits with the rest of the world, because the way to think about it is that the only way for the rest of the world to get dollars is either to acquire them through trade or through, foreign exchange markets, right? Because they can't produce those dollars. And so his kind of fundamental point is that if the rest of the world is going to use dollars as the primary currency that's used in trade, then that means we have to be a net exporter of dollars. We have to provide those dollars to the rest of the world. And so that means that, that corresponds with trade deficits. And so a lot of people in the economics profession will say, well, that's not like really a big deal. Like we're providing dollars to the rest of the world. They're providing us goods like that, that's the trade, right? Like they want dollars.
I like Prosecco, man.
Yeah.
I want to keep importing it from Italy.
Yeah. So they want dollars. We want goods. Like that just sounds like trade. And his fundamental point is that, again, that like, well, if you're not providing enough dollars to the rest of the world, right, then what tends to happen is they have to go acquire those in foreign exchange markets. And so if they're going to foreign exchange markets to acquire those dollars, that's bidding up the value of the dollar, right? And that also, if you compare, economics is about the counterfactual, right? So if you think about the counterfactual, his point is that there's some component of trade that is not based on sort of comparative advantage. It's based on the fact that there's a premium on the dollar relative to what it would be in a world where it's not the primary currency used in trade. And his point is that when the dollar is overvalued, what this tends to do is it tends to give people incentives to move production out of the United States and into foreign countries, because not only might those foreign countries already have cheaper labor, but now if the dollar is sort of overvalued, well, then what you can essentially do is you can make an additional profit by paying those workers the low wages in their local currency, and then by generating revenue in terms of the stronger dollar. And so his point is that that sort of a thing is going to tend to hollow out manufacturing, and it's going to tend to move a lot of that kind of production overseas. And I think, and again, a lot of economists say, well, who cares, right? Like what's the optimal level of manufacturing in the United States or something like that? How do we know that we were already at the optimal level, or how do we know we're below the optimal level or something? And I think this gets into more complicated issues, which is that manufacturing, it's not so much manufacturing in and of itself that's important. It's sort of manufacturing capacity that's important, and the sort of skill set that people who work in manufacturing have. And so,
define capacity. You mean like not having enough labor to be able to crank out goods? Like, what do you mean by that?
Yeah, so having sort of both, I would describe it as like the physical and human capital necessary to do these things. So having the infrastructure in place to where, I guess what he's really sort of highlighting, and what the Trump administration is really highlighting, is like, if you look historically when when countries go to war, especially the United States, like a lot of what they would do is they would convert manufacturing to like a new use, right? So maybe you were producing cars and now you start producing tanks or something like that.
Right. Like they did during World War II.
Right. And so the idea is that if you're losing the physical and human capital necessary to produce like cars, for example, well, then you're not just losing that for cars, you're losing that for tanks in the event that there's some sort of like war that takes place, right? Is that you don't have the people who have the skills to build these things, and so if you don't have the infrastructure and you don't have the people with those skills, then it's going to be very hard to sort of ramp that up if you find yourself at war. And I think the things that they point to is like, I don't know if you've seen these things. They're very prevalent in the South. There are all these campaigns by the U.S. Navy for this project they have that's called like Build Submarines or something. And the idea is that the Navy would like to build more submarines, but they can't find workers they can't find welders. They can't find people who have the skills necessary to build those things. And so they're engaging in this campaign to try to convert people. Like they're advertising like they're putting advertisements on cars and NASCAR races, and they're advertising at like Alabama football games and stuff like that. And so I
saw it at a Red Sox game.
Yeah. And they're trying to get these ads in front of young male people because the Navy has found that like we do not have the human capital in the United States to build what they would like to build, and they're having trouble finding people with those skills. And so their attitude is like, well, we need to go out and we need to give, we need to find the people who would be welders, who would have these skills that we can kind of bring in to work for us.
And so so basically, to tie this all together, we lack that level of human capital. We lack the capacity, the output. We lack the physical goods, the capital goods, I should say, the factories, etc. So is Miran's point that, if I'm saying his name right, is this point that we need to bring that back to the United States, and one way to bring that domestic manufacturing and increase the manufacturing output and capacity, that is done through trade? Correct. That's done through trade barriers and tariffs. So, and there's so many different questions I can go with this one. We'll just kind of start one at a time. Do you think that he believes that these aggressive trade barriers are the path forward to reconciling these problems?
Well, so there are a couple things. So what I would say is like, he doesn't deny that like some of this shift in production is
driven by normal things like comparative advantage.
I was going to say that.
Yeah,
comparative advantage.
Yeah, his argument is that, some of this is comparative advantage, but some of this is is just that we have this system that we have this international monetary system that sort of is distorting some relative prices. And by distorting those relative prices, it's sort of exacerbating that trend, right? So that even in a world where the dollar wasn't like the global reserve currency, you would probably still see some of this manufacturing moving overseas just because of cheaper labor and things like that. But his point is like there's even more than you would expect, because some of it isn't just driven by the cheaper labor. It's driven by the fact that the dollar is sort of artificially strong.
So this isn't a genuine market, right? Is that his premise? Like, if this is driven by normal market principles, we wouldn't see these types of asymmetries with trade. And if it was, because I hear these theories with like the way people debate over monetary policy. You hear some people say, well, and if we didn't have a central bank, we wouldn't have fractional reserves. There'd be 100% reserves. And other people say, oh no, there'd be fractional reserves. And there's these practical debates that then lead to how different people view Federal Reserve policy. And I've always seen that extension since I've studied economics and finance from the beginning of my career, but I never thought of it in the terms of extending that to something like trade policy. If you agree with my theory here on this, it appears that he believes the markets are so distorted, and he would be taking it back to maybe what would be more of a natural market scenario. Is that a fair way of putting it? And do you think that's how he thinks?
Yeah. So I think like their argument. Well, I mean, there is this kind of really weird thing, because I do think that it's maybe not like a libertarian argument, but it is kind of like I do see it like as a conservative argument, even though a lot of conservatives don't see it as a conservative argument, because I think that like libertarians and conservatives have kind of reacted negatively to some of the things that he's saying, because they see it as anti-free trade, and sort
Correct.
of like conservatives,
anti-capitalist,
right? And so conservatives and libertarians are sort of instinctively pro-free trade, and
correct.
So, but I think but his argument is not that like trade in and of itself like is bad or something. It's not that like all else equal, we don't want free trade. That's not really his argument. His argument is that we've created this international monetary system, and that's an important point. Like, we have created it. It might not have been created by design, but it was created on purpose. Like, the reason that the dollar has the status that it has is the U.S. used its power after World War II to sort of cement the dollar as like a quote unquote perfect substitute with gold under the Bretton Woods system. And then when the Bretton Woods system broke down, the United States government took a lot of diplomatic steps to sort of make sure that people kept pricing commodities in terms of dollars, to make sure that people were taking the dollars that were flowing overseas and funneling them back into U.S. treasuries. And so it's not as though like we've designed this system, but the United States government certainly took a purposeful approach to kind of giving the dollar this role. Now, would it have that role anyway? Well, at least to some extent, because there's always going to be currencies that are going to be used internationally in trade, and that will be tied to things like geopolitical power and trustworthiness, that kind of thing. But his point is kind of like, this system has created a market distortion, and so we can't just say, oh, this is all just comparative advantage, or this is all just normal free trade. That like this, it's created a distortion, and that some elements of, so depending on the circumstance, that distortion can provide lots of benefits to the United States. But other circumstances, that distortion can create costs for the United States, right? Like, that's really the fundamental point. And so, but again, that gets back to like why I think it's important to understand like why they're doing things and trying to understand their arguments, right? Is because this isn't if you are like a nerd like me who travels in these circles where people are thinking about these issues all the time, like you hear arguments like this. But if you're just like average man on the street, or if you are just somebody who kind of like pays attention to the, news, but, doesn't, kind of travel around these policy circles, these things sound like completely foreign concepts. It sounds like where did this idea come from? Like, who is even talking about these kinds of things? And I think that is, but I think that's primarily driven by the fact that when this system was working for everybody, what you saw is that Democrats and Republicans both kind of aligned themselves with the system because, it seemed to be working for everybody. It wasn't working for one party over the other. It didn't seem to be working for one voter base over the other, right? Like, it seemed to have broad kind of benefits for society. But now, I mean, you see this in our politics. You see that there are very much these divides where people kind of see the system not working for them, right? And it's not always communicated well. Sometimes, it's not the system. But I think the fundamental thing that's important here is just to kind of understand like the why of what they're doing. Because regardless of whether you think this is a good idea, you need to understand why they're doing it. To get a better sense of, what is ahead, right? Like, where do we expect to go with these policies? And so I think that is where a lot of this trade policy is coming from. Now, when it comes to trade policy, I think that's where there's a little bit more uncertainty about like the future path, because I think within the administration, there's broad agreement that we have to do something about trade to kind of try to correct these distortions. So in economics, we would call these sort of like second best policies. Like, the first best policy would be to remove the distortion. The second best policy would be to take steps to try to correct that distortion, like through some other policy, right?
Sure.
And so they are really kind of aiming at a kind of second best solution here, which is maybe we can use trade policy to kind of correct that distortion that's created by this other sort of international monetary arrangement, right?
So instead of dealing with, say, the debt issue and the foreign exchange markets and the overall demand for treasuries and just other nations acquiring our debt, like that would be the sort of the first way of attacking it. Instead, we're going to go through this other way of attacking it, which is, well, we're going to fix that problem by engaging in trade policies, and we're going to come through the back door to fix it. And I'm sorry, what was the stages that you were talking about?
Oh, so like I guess the important thing here is like where there's disagreement, I think, within the administration.
Right.
So I think like if you read Stephen Miran's paper, for example, and you listen to like his testimony that he's given to Congress and things like that, it's very clear that he kind of sees he sees the ultimate goal as figuring out a way to sort of devalue the dollar internationally to sort of correct the distortion that's created by the system. And so the tariffs for him seem like a way of sort of, look, maybe the tariffs themselves will result in a devaluation of the dollar because people will see the United States as like pulling back from its sort of role in international trade or something. And so that will sort of devalue the dollar in and of itself. Or what happens is that, those tariffs, to the extent that they're imposing costs, then it brings other countries to the table to get them to maybe sort of revalue their currencies or do things like that. That seems to be very much like his kind of attitude on that. There are other people within the administration, and it seems like their attitude is that like, no, like the tariffs should be like a permanent component of,
like Peter Navarro would be an example of that, I presume.
And like they think, no, this should be like a permanent component of policy where we essentially have to adjust. We have to essentially impose these tariffs to try to correct relative price distortions, right? And that and that the only way to do that is to have these tariffs in place for a long time. And then the other aspect of this is then there's also a question of like, how do you implement these things? And I think this is where people get the most frustrated with the policy, because the way that the Trump administration seems to administer these tariffs is the way that you might, I don't know, say do like a real estate deal, right? So you come in, you make a ridiculous offer right? But
It's called a high anchor in negotiations, right?
Right.
So he's a high anchor guy.
Yeah. And so that's what he does. And then, people freak out. And then he says, well, let's figure out.
We're at 100. We'll take it down to 20. Is that fair for you? Right.
Right. Exactly. And it's, and so that's the thing, is that's how he prefers to negotiate. Now, when you're doing, if you're negotiating your wage or something, or if you're negotiating a real estate deal, that can be like a really successful strategy. When you're negotiating tariffs, this can be incredibly costly, because the people who are engaged in this production, like one day they think the tariff's 100% and the next day they think it's 10%. That makes it very hard to do any kind of long-term planning. And I think that's actually where, in my own discussions with business owners and people who are engaged in a lot of international trade, this is actually the one thing that they all kind of universally say to me is like, look, if there's going to be a tariff, I can deal with it, right? Like
I can adjust to certainty,
right? But like, if I don't know what the tariff is going to be, like, it just makes it impossible for me to do anything, right?
So you freeze. Yeah. It's the classic problem of entrepreneurial uncertainty,
right?
Which played a huge role in extending things like major crises like the Great Depression.
Yeah, and
it's like we had no idea what FDR was going to do. Like at one point, he was proposing 100% tax on the top 1%. I remember reading that not that long ago, and it was at 90% at one point, and then there was all these new federal programs. Like, by the way, I'm not in any way predicting a depression here under Trump by any stretch of the imagination. This is a very different environment. But I'm always a little worried about entrepreneurial uncertainty, because I'm an entrepreneur and I run businesses and I have payroll and I have staff, and there's all these things you think about as someone who runs a business. And when all of a sudden uncertainty creeps in, whether it's artificially imposed by a government or it's just some sort of business environment naturally that's sort of endogenous to your industry, the moment immense uncertainty happens, we all just hit the brakes. Like, I just got to figure out where this world is going, and until I know where it's going, I'm not going to do anything. And that is, are you seeing a level of that uncertainty that could start to have some sort of an impact on the broader macroeconomy?
So it depends how widespread it is. I mean, certain industries, you're clearly seeing it. Like, there are just certain people where this is so much uncertainty for them that they're just kind of, they're not going to do any investment. They're not going to make any big decisions during this time. They're just going to kind of operate, normally as best they can until they get some more certainty about how all of this stuff is going to be resolved. And look, I do think it's actually an issue, because the anchor, you can use the anchoring argument to describe what he's doing with lots of other countries, but I do think it's like a little bit more complicated with China, because I do think there are actually like legitimate issues between the U.S. and China, and sort of tariff policy has become the way of dealing with those issues. So like, I see these things as much more, I see like tariffs on China as I see this having to do much more with like diplomacy and foreign policy than with economics. Yeah. So,
and I agree with you on that.
Yeah.
Yeah. And you saw that too with the recent scuttle over rare earth minerals. Right. And I'm with you. I don't think it's just, hey, I'm going to anchor you up here to bring you down. I think he looked at it, and Trump is troubled by what feels like a bit of a monopolistic control over rare earth minerals, the way they're able to manipulate other trading partners in other nations with the power that they have over those markets. And so Trump is stepping in my estimation, to say, time out, like, you don't get to do that. And I'm going to drag you all from Beijing to the White House. We're going to meet somewhere, and we're going to try to discuss what is a fair path forward. What's your take on my opinion on this?
No, I think that's right. I mean, I think that this is fundamentally about, this is like the tariffs with China are actually just indicative of this sort of global power struggle, right, between the United States and China, right? China is sort of seen as this rising power. They're trying to assert that power in international markets. They're trying to get much more involved. I mean, if you see like what, like the things that China is doing, like with its Belt and Road initiatives and things like that, like a lot of these things are like mirror images of things that like the United States and Western Europe have done through like the IMF and the World Bank and those kinds of things, right? And so you very much see, the Western world, but in particular the United States, sort of standing up and recognizing that China is trying to sort of do a workaround of it. I mean, you hear this all the time of kind of this sort of global order or something, right? Like that we have this. What's funny about this is like whoever's saying it has a completely different perspective. Like in the Biden administration, they always talked about the global order as though this was like an established thing, and like people were in violation of this established thing that, hey, we all agreed upon this. And when the Trump administration talks about it, I guess what I'm trying to say is the Biden administration always seemed like surprised, right? Like, no, this is like, these are the rules that we've agreed to, and now you're violating those rules. Whereas like the Trump administration is more like, hey, everybody, like we would like to play by these rules, but these people over here, they never play by the rules. And so it's very much like, I think like to a large extent, like I think the parties recognize who's not playing by the quote unquote rules, but I think the Biden administration had a sort of naive view that like everybody actually agreed to these rules, when in reality, like these rules are really rules that were kind of created by the United States and Western Europe after World War II. And so these are really sort of like US / like British rules, right? Of this is how things should operate, and this is how they operate when the United States and the UK have all the power in the world. But China's sort of rising power and Russia's desire to constantly try to like poke the West in the eye and things like that. Like these are things that you can complain that they're not following the rules, but like Russia and China never really agreed to follow the rules in the first place. I think the frustration with China is that like Russia's never really pretended that they were going to follow the rules. Like China sort of initially kind of did, like, oh, we want to join the World Trade Organization. Oh, like we want to be a member of the IMF. We want to do like these kinds of things. But that actually just seems in retrospect like, no, like that they were just in a position of weakness. And so that was their way of sort of integrating themselves in with the rest of the world when they were in a position of weakness. And as they rise to a position of strength, like now they want to change their strategy. And so, the interesting thing with that is, again, like in economics, everything's always about the counterfactual. So when people talk about, hey, we seem to be in this trade war with China, the relevant question is always like, well, compared to what, right? And so I think that like, there's a lot of talk where it's like, well, this is a Trump administration thing. I'm not really sure it's a Trump administration thing. Like, I kind of think that no matter who is president, like you would have now, maybe the tariff thing is the Trump administration thing. Like maybe that's their preferred way of doing it.
Yeah, the policy means might be different, but the perspective on China as becoming a more nefarious global force seems, I think what you're saying is universally kind of accepted between both parties and various members of the factions of each, the Republican and Democrat. Is that what you're driving at?
Yeah, like here? I think a lot of like the discussion on China is like it sounds like we're having a debate about like the ends, but I think actually like within the United States, what we're having a debate about is like the means.
That's a powerful statement, Josh. And this is interesting because I feel like so much of the dialogue, and I think I've been guilty of this in all fairness, is we've kind of created straw man arguments based around why the Trump administration is doing this. And it's not all incorrect either, but I think what you're providing is a more complex peek into the White House and why they might be pursuing certain policies. And it's beyond just like free trade is good versus free trade is bad. There's probably a fundamental belief, and I've heard this from many members of the White House, particularly people like Scott Benson and Trump himself, where they will say things like, no, we believe in free trade. We believe in comparative advantage. We just think that it's unfair. But what politicians rarely do, and that's because the public, frankly, doesn't have the desire to be more nuanced or complex in their understanding of it, is they have to give very simple explanations to a very entertained population that is used to quick sound bites. They're used to going home and watching Netflix all night. And so there is no way to disseminate what you're describing. And frankly, a lot of people that would listen to this podcast, Josh, if I'm really honest, they're gonna zone out in the first few minutes. Not to be patronizing, but it takes even for me today, I'm learning from you. I've said very little in this interview because you're actually stripping back some of my preconceived ideas that I think I was wrong about with the Trump administration. And it takes some mental energy to get to the bottom of, well, why is the administration actually doing this? And what does this actually mean? And I think the point you're making, and please correct me if I'm wrong, is this has way more to do than just tariffs. There are other major policy considerations and global geopolitical dynamics at play that I don't think is getting disseminated to the public. And I don't even know if politicians have an effective route to do so.
Well, and I think, too, that's the challenge, because the other thing that makes this difficult is like the first Trump administration was actually just very chaotic. And it was very chaotic because, I mean, I think in hindsight, like, I mean, I don't have inside information, but I think in hindsight, I think there was a lot of like, I don't think they expected to actually win the election.
Oh, he looked shocked. I remember staying up till 2 a.m, and he looked like what just happened.
and so like there was a lot of chaos because there are a lot of positions to fill within the government, and I think like if you don't have a team in place before election night that's ready to go, now you're sort of scrambling to find these people and fill these positions. And one of the problems that you had too in 2016 is you had this one segment of like the Republican Party that was like very, very much like pro-Trump, right? And those people were trying to get into the administration to help, with what they perceived as like the vision of, his candidacy. But then you also had this other subset of Republicans who were very anti-Trump, but they were also trying to get jobs in the administration because like their attitude was like, we're going to steer him in the right direction. Right.
Yeah.
And so I think that led to a lot of, I think that led to a lot of chaos. But I think the difference this time around is that they were extremely prepared. Like they expected to win this time around. They had the people in place. And I think like it's really important to mention that because Scott Bessent, if you go back, you can find these videos back in 2024. He was going around giving talks, going on CNBC and these kinds of things. And he kept saying things like, look, we had a Bretton Woods system, and the Bretton Woods system, it lasted for a certain period of time, but like, it was unsustainable, and we had to move to a new system, and we moved to that new system. And now we're it looks like maybe we're reaching kind of like the end of that system, and we kind of need to start transitioning towards like a new system.
When was he saying that? Like roughly the time frame?
This was like summer 2024. Like,
okay.
Yeah.
Okay. Keep talking.
And he was saying like, but he would say things like, and I would like to be part of that, right? Like, so he was like very much campaigning, right, to kind of have a position here, right?
He's a lifelong Democrat,
and
he's a staunch Hillary Clinton supporter. So it's interesting watching someone like him say, "Hey, I want a piece of the action. I want to be a part of the Trump administration."
Well, and I think too, like the other thing is, like I've been explaining to people, I've been trying to explain this to people, even people that like normally agree with me on lots of things, because like we appear to sort of disagree, and I'm like, I'm not really disagreeing. I think that like I'm trying to understand what they're doing, and I think that like they say things that people think don't make sense, but I think but makes complete sense to me. So, for example, like Benson came out yesterday and said something to the effect of like the gold, like the price of gold is at a record high, and that's good for the U.S., right? And this is, and so like you would look at that and you would go like, first of all, like why? Like what does that?
Literally, I don't know if you saw my face. I'm like, it's not computing.
But I think what he means by this is Besson's kind of view, which is another sort of view within the Trump administration, is that sort of like long term, what we want to do is we want the dollar to be kind of like that we still want the dollar to be the dominant international currency.
But we want it weakened?
But his view is kind of like what you want is you want people to diversify, like in order for us to have a sustainable debt trajectory and not have these distortions, right? Where we either have really low interest rates or we have really fast growing debt, right? I think his thing is like, we need central banks to actually diversify. Like we need them to not just hold treasury bonds, but hold other assets. And I think this is why, the Trump administration, probably more than any administration of my lifetime, like they spend a lot of time talking about gold. and they spend some time talking about Bitcoin, right?
Well, they did the Genius Act, right?
Yeah.
And they created some regulation around stablecoins, which is, now that you're talking, it's like, that's fascinating.
Yeah. And so I think like this is all part of the same thing. Like I think the reason that they talk up gold and Bitcoin and things like that is I think they would like people to, because here's the thing, all previous, I think that most people recognize like these costs with the international system and what it does with U.S. debt and that kind of thing. I think there are a lot of people who do this. In fact, like I would say like older Democrats, maybe not like of recent elections, but like older Democrats kind of recognize some of the inherent like issues with the system. The problem is that it's not, even if you recognize these issues, it's not really clear how to correct them. Right. And the one thing that that people of all parties fear is like they don't want to try to make a change to a system that results in the dollar no longer being the dominant currency, but then that dominant currency being something else, like maybe it's the euro or maybe it's the yuan or something like that. Right. Like,
sure.
And the reason that they don't want that is that, yes, there are all these costs that we have from these systems, but we also get benefits. And so we would like to minimize the costs, but we would like to retain the benefits. And I think that's the difficult thing, because to me, that is what the Trump administration is trying to do. They're trying to minimize the costs of the system while maintaining the benefits. Now, I don't know if that's possible, but that seems to be their objective. And I think that the issue is that the reason that they tout things like gold and Bitcoin is if people those are neutral assets, right? Like they're not created by a sovereign country.
Yeah, it's not a fiat currency.
Right. And so if people were to substitute away from
government fiat currency to
right.
be precise.
Right. And so if people were to say substitute away from like treasuries and into gold, yeah, like to some extent that weakens the dollar, but at the same time, it's not empowering another currency. It's not transferring the benefits to somebody else.
Is that why they promoted, because they've been talking a lot, like I follow David Sachs, who's in the administration, and David Sachs has been one of the architects of the Genius Act. And do you think that's part of the reason why they wanted to craft some regulatory certainty around cryptocurrencies? Because cryptocurrencies, in my estimation, Josh, has lacked legitimacy, sort of ironically, because I'm a free market kind of guy, but it has lacked a level of legitimacy because it didn't have any sort of regulatory framework. An example would be, I run into this with clients, although I don't transact in cryptocurrencies at all. I talk to clients about it all the time, and they run into tax issues. And one of the questions is, well, if it's a currency, do I pay taxes on it? Right? Like if there's a capital gain and I appreciate that capital gain, is it a short-term capital gain? Is it treated like a stock where it's taxed at 15 to 20%? Or is it a commodity where it's taxed at 28%, which is a very different ball of wax? Or is it a currency? And a currency, theoretically, at least according to the IRS code, is not subject to any form of taxation because I'm using that as a medium of exchange. And I think the lack of regulatory certainty delegitimized, sort of ironically delegitimized cryptocurrencies as a viable alternative to something like the US dollar. And by, I think, paradoxically creating a regulatory framework, particularly around stablecoins. And it's interesting, they only dealt with stablecoins, which they did not deal with everything, but they did deal with stablecoins, which is denominated in US dollars. I think my take on this, and I'd love your feedback, is that they were doing that as yet another currency to help legitimize that currency, make it more accessible, and therefore maybe money would. And I'm basically taking my ideas and I'm latching them on to what you've told me today. What's your take on that?
Well, I mean, I think that you're right here in the sense that there were really two things that they were trying to push when they came into office. There was this sort of stablecoin bill, but then there was also a sort of market structure bill that was going to provide clarity on like regulations for like cryptocurrency in general, right? So some of these projects, you know, like, yeah, they have a cryptocurrency, but it actually seems more like it seems more like a stock or like the conventional definition of a security.
Correct.
But the thing is like nobody knows, right? You don't know until like under the Biden administration, the way that you found out is like the SEC would just sue you, right? Like this is
unless you're Sam Bankman-Fried,
right.
then they meet with him,
right? And but I think the thing is if you look at the stablecoin bill, to me, it's very clear what's going on because the stablecoin bill is the thing that was the easier thing to do. But I think the reason it was the easier thing to do is like this is how the stablecoin bill works. The stablecoin bill requires that people who are issuing these stablecoins, those stablecoins are liabilities, right? It's just like it's like a very narrow form of a bank. So they're issuing these stablecoins as their liabilities, but then it requires that on the asset side of their balance sheet, they have to be holding dollar reserves, or they have to be holding U.S. Treasury bonds,
which would put wouldn't that put greater demand on? So I take my theory back. That puts more demand on treasuries then.
Well, but I think the thing is that from their perspective is that one of the challenges that the U.S. government faces, right, is that we have this rising government debt, and so at least in the short run, we need some passive demand for that debt
to bring rates
right?
To bring rates down so we could service our debt at a lower rate. Is that the theory?
Yeah. So it's like we need a passive demand, like interest insensitive buyers, right? And so like if you are a stablecoin issuer, the only thing that you can only hold reserves at the Fed. You can only hold dollar reserves at the Fed or U.S. Treasuries. So if you can only hold those reserves or Treasuries, okay. First of all, if you're holding more reserves, that's just going to allow the Fed to buy more bonds. If you are, but also if you're holding U.S. Treasuries, like now you're creating this passive demand because the amount of Treasuries that these companies are buying is going to be conditional on like the demand for the stablecoins, right? So the way that they're able to make money is you're not allowed in the bill to pay interest on stablecoins, but you're collecting interest on the asset side of your balance sheet from the Fed or from the U.S. Government through Treasury bonds. And so the stablecoin issuers, they essentially have a money pump, right? Like they're issuing a liability that doesn't pay a return and they're using it to buy assets that do pay interest. But the thing is that the demand for those stablecoins, when those dollars flow in, those dollars are going to earn interest no matter what. And you're just going to buy treasury bonds. And so it's creating this passive demand. If you're running a stablecoin issuer, you're not paying attention to like, well, do I really want to buy treasuries? Like what's the interest rate? Do I really trust it? No, like you need to earn interest. So that's how you're going to profit. So you're just going to passively buy these treasuries no matter what they're yielding. And you don't really care because the interest you're paying on the stablecoins is 0%. So anything above zero is profitable for you. So you're not interest sensitive. But the thing about this is that,
and they can't buy any other type of security to denominate in. They have to purchase treasuries, correct?
Correct.
Okay.
And so, but the thing is that I think that they see this as a way of sort of tapping into, I think that they see this as a way of tapping into a new market, right? Because there are people all around the world who would like to hold dollars. They can't access those dollars, maybe because of capital controls, maybe because dollars are just hard to come by, maybe because anybody who has access to dollars in their country is hoarding them. They're not in circulation. You can't acquire them. But so with stablecoins, anybody in these countries who has access to a smartphone can download a crypto wallet and they can get stablecoins. And so there are people around the world who want access to dollars. Anybody with a smartphone can get those dollars. And then to the extent that that's a net increase in dollars around the world, what that's doing is then that's also increasing the demand for U.S. Treasuries. And so actually what this really is it's kind of a form of financial repression, right? So when we talk about financial repression is like just basically when the state requires that financial institutions hold their debt as some percentage of their assets. Like in this case, they're literally just requiring these companies, that's all they can hold. They can either...
And it has to be 100% reserves, correct?
Well, I mean, it's not technically 100% reserve in the sense that like some of their balances are going to be like true reserves, like held at the Federal Reserve. And some of them are going to be in treasuries. And so those treasuries are really liquid, but it still takes time to settle. So they're...
regarding, I'm speaking of the stablecoin issuers specifically, and obviously not banks.
Right. So, I mean, I would say that they're kind of like money market mutual funds, right? But they
don't pay an interest.
But they don't. But exactly.
Owner.
But they don't pay interest, right?
So, what's the benefit of a buyer then? Like, why would Drew Benson? Why would Josh? Why would we go out and buy a stablecoin?
Well, I think that there's two fundamental use cases. So there's already people who are just like, there are already people who are, using, like these DeFi protocols and things like that. And like, so stable coins are just an important sort of temporary store of wealth on those platforms. So people like that are using it. But I actually think what it's really aimed at is it's aimed at getting, like, the people who really want to hold these things are going to be people who just don't normally have access to dollars. They're going to be people in other countries who want to hold dollars, but they just don't have access through like the traditional financial system to get those dollars. Well, if they can get a smartphone and a VPN, they can get stable coins. And so if that's the case, then that greatly expands the demand for dollars. But that's kind of the use case, is that you can create a sort of parallel economy in these places where people are trading using dollars, but they would be using maybe stable coins instead of actual physical U.S. currency.
So let's go back to the Trump administration and tariffs. And I should just rip the script over here, because I said that this conversation may naturally flow before we record it, and we did. I don't even know if I'm going to get to the Phillips curve today, which I'm enjoying this immensely, Josh. So we might have to record another episode another time about the Phillips curve. But let's go back to the Trump administration for a moment, because I think what listeners in particular would love to know, and this can kind of be our transition point, is, okay, practically now, you've set a framework around the interworkings within the White House of the nature of the tariff policies and maybe the deeper reasons of why they're engaging in them. And from what you've said today, my takeaway is it is a lot more complicated and complex in nature than I think what even the Wall Street Journal is reporting, or other outlets are reporting, or even a lot of financial firms are reporting. There's a lot more interplay that is occurring. And also, and this is the first question I have for you on sort of the practical ramifications, it also seems like the White House itself, there seems to be different players. Like, it seems like Benson, like I remember reading a Wall Street Journal article where Benson and Howard Lutnick, who's one of the trade advisors, kind of cornered the president and said, I think Navarro had to leave the White House for some personal matter, sort of cornered him based on reporting that, hey, we need to back off on the tariffs. Because now the stock market was starting to cripple. This was back in the spring. The Treasury, like the bond market was starting to cripple as well. I think that was scary for them. And they started to back off. It doesn't seem like the different factions in the White House are on the same page. So my first question is that true? Is there a level of infighting? And then the second question to you is, based on what you know, not that you're friends with the guy, but based on what you know, where do you think Trump takes this over the next 6 to 12 months? What is his take on tariffs specifically?
I mean, I think that there is broad agreement within the administration on policy. Like, so I think if you're talking about big, broad overview of, hey, what do we need to do? I think there's a lot of consensus there.
And is it geopolitical predominantly in your mind?
Yeah, I think so. Yes. And I think
is this containing China predominantly?
I think that's one of the aspects. Yeah. I mean, I think,
okay.
And then the other, but I think the thing is like, there's broad general agreement, but I think that then when you get into the specifics, I think that's where the disagreements come. So I think like there are so I mean, with China specifically, for example, like there's people who really, really want to take like a hard line on China because they kind of feel like the United States is still in a position of power over China. And so you can take a hard line and you can win and you can be successful by doing so. I think there are other people who are thinking more long-term, who are kind of like, hey, we don't know if that kind of a strategy would work. So like maybe we don't want to take like a super hard line, but we do want to move in that direction. So we do want to take steps to impose tariffs on them, to try to get them to negotiate things with us, to try to, to try to move in that direction, because we don't want to, because of, I think those people's perspective is, if you take a hard line and you lose, that's really bad. Right? So it's like a high risk, high reward strategy. If you take a hard line and you force China to give you everything that you want, well then, yeah, that's great. Okay. But what's the likelihood that you're going to be able to do that? And if you're not able to do that and you take a hard line and you don't get what you want, well, first of all, politically, this is very bad for you, but also just in terms of like the United States, this is bad, because now you've kind of put yourself in a position of weakness, right? And so I think like the people who are thinking more long term, they're thinking, no, like we need to take much more like slower, deliberate steps. And we need to take those more slower, deliberate steps to move in that direction. I think those people are winning, actually. I think early on...
Is that Scott Besson? Is that the Lutnicks and the Bessons?
Yeah.
I think that who's pushing this incremental approach?
Yeah, I think they recognize that you've got to that the important thing is to move in that direction, not to just push all of your chips onto the table, right? And I think that they are very much the ones who are kind of like, let's sort of move gradually towards what we want. Let's try to, and also because moving gradually also allows you to kind of adapt your strategy a lot more. I think that like this issue of, hey, where they roll out like Liberation Day tariffs and all that kind of stuff. Like, I think this is like the sort of hardliners sort of winning the day. And that did
not go well. That did not go well in the financial markets. It was perceived poorly. I think it hurt him in public opinion polls. At least that's my opinion. And it seemed like, again, I kept reading these articles coming out of the Wall Street Journal, because they had some really good investigative journalism happening. At least sometimes they try to be journalists at the Wall Street Journal. I can't believe I still pay for them, but I do. But that's the thing. You could see a shift, right? Yeah. Like I noticed, like all of a sudden they were shifting, and Besant was pressuring the president to put a pause, and that's what's like, okay, we're entering a new phase with the tariff policy.
Yeah, but I think too, like that was probably also kind of like the most damaging thing to the administration was that whole experience, because I don't think it ever really took on other than like among people who already are on the left. But like there were people who were framing this as like, oh, Trump, he just chickened out. Like he just chickened out. Like he talked a big game and then like he didn't actually do these things. But I think that actually speaks to like part of what they were trying to get across to him. And by they, I mean like Besant and Lutnick and people like that, is that like, look, if you take these dramatic actions and then you have to backtrack, like that's going to make us look weak, right? And so if instead, we sort of move, more slowly and deliberately, then if we have to change course, it doesn't look like we're doing something dramatically different, right? Like we're just adjusting policy to the circumstances. And so I think there's an aspect of, I mean, I don't have inside information, but
I don't either.
But my impression is that, people like Navarro aren't having the kind of they're not having the same kind of hearing as, Besant and Lutnick. Like Besant actually seems like he is the one who's driving all of this policy.
That's my take too. That is my take too. Because in this one article that I read, Besant asked Trump, said, how concerned are you? I think it was like, how concerned are you about a recession? And the president said back to him, I'm actually concerned about sparking a depression. And so you're starting to see sort of some practicality. So people get mad at me when I say this, because I've got clients all over the political divide and I have friends all over the divide. But I actually think Trump is a profoundly pragmatic man. And I think compared to other presidents, my general take on him is, in some ways, he's highly ideological, but in other ways, he's really subject to change. And I don't think he's as ideologically driven on certain matters. And I think he's willing to pivot. And so I think you're seeing him not pivot on the grand strategy, but pivot on the implementation of the strategy. Do you agree with that? It seems like you do, but do you agree with that? And like, what is your take on like how willing do you think he would be to drive us into a bear market at some point and spark a recession?
No, I think that he is. No, I think I do agree with you. I mean, I have talked to some people who worked in the Trump administration, in the previous administration, and the impression that they give of like what it's like to work in that administration versus like the public impression is very, very different. You know, like there was like you'll hear these stories where it's like, oh, Trump doesn't like to read and Trump doesn't like to like do all this stuff. No, like what's actually going on is like Trump wants you to tell, like he wants you to give him the information he needs. Like I'll give you an example. Like somebody once told me that like when they're trying to pick somebody to nominate for a position, like he would get really mad during that first administration because he would reach out to like some right-leaning think tanks and he would say like, who should I appoint? And they would just give him like lists of people, right? Like they would just give him like a list of like 10 people. Oh, like, you know, here's a list of people you could choose. And he would just throw away the list. And they would, and so like the argument was sort of like this fell into this thing of like, oh, Trump doesn't want to. No. Like what he's doing is he's asking you who he should nominate. He wants you to give him like one or two names. He wants you to tell him like, this is the person, right? This is the person and why. Don't just give me a list of 10 names and then like my staff has to go research who these people are, right? Like,
yeah. That would make me mad.
Yeah. And so
I'd probably throw the list away myself.
And so I think like there's the external view doesn't, of how he operates doesn't match with like what has been described to me from firsthand experience. And so, you know, I obviously am going to defer to firsthand experience over like reporting, even if you're a really great reporter.
Sure.
But I think, but also you see this anyway. You see that he's very willing to do things like even when he's just like when he was campaigning, he did like a lot of A/B testing. Like you would see him go to rallies and he would say something at one rally and then like at another rally he would say the complete opposite thing, right? And then he would like wait for the reaction of the crowd. And actually like he does this in a very subtle way, so it's not as obvious, but like one of the obvious things but there are certain times when it's very obvious that he's doing this. So like when he went to like remember when he went to like the Bitcoin conference, right? When he went to the Bitcoin conference, he was like, the first thing that I'm going to do is I'm going to fire Gary Gensler as like the SEC chair. And the room went nuts. Like it's like the loudest you've ever heard a room. They went crazy. And you watch his face and his eyes kind of get big and he kind of like leans back and he looks around but then he says, and so you can see what he's doing. He says, "Oh wow, that was really popular." And then he goes, "I think I'm going to say it again." And then he does it again, and the crowd goes nuts again. And
that's such a Trump move.
and so the thing is that these, but that's how he kind of is on the campaign trail, and I think that's kind of also how he is when it comes to decision making. Is it's sort of like he's got, you know. Is that he's trying to figure out, okay, which is the better way to do things? Like this person is telling me to do this person is telling me to do that. And I think to some extent what he does is he just picks one, but he's not tied to it. So he picks one. Sure. And then if it seems like super unpopular or if it seems like it's not working, then he's like, well, okay, that's wrong. We're going to do the other thing instead. Right. And I think he does do a lot of that stuff. And I think that, you know, I think what makes it really hard for people to really judge is that we're so used to the polished politician, right? We're so used to the person who, you know, like they're not doing A/B testing in front of the camera. They're doing A/B testing behind the camera, right? And so everything that they say in front of the camera has already been A/B tested, and they're already, you know, they're already on their talking points. They're already, you know, like, they always appear to be acting with certainty because they've got they've already done the sort of background that they think is going to be the right policy or the right messaging or the right whatever. Whereas he is just not like that at all. I mean, to say that he's not it's funny because he's not at all a polished politician, but he is like an amazing politician, right?
Yeah. He's skillful,
right?
at the craft of being a politician and convincing people to vote for him, which is traditionally what politicians do. So he's no different. But to your point, he also his means of doing it are very, very different, very, very different. Like I remember watching someone like Mike Pence in comparison. Mike Pence was always very. It was relatively wooden, right? It's like he had a team of consultants behind the scenes. He knew exactly what to say, where to be, how to sit, how to button his coat. Like everything was kind of orchestrated. Where Trump is, man, he's impromptu. He's an impromptu guy. So let's get real practical for a second about the markets. And this is what's been interesting for me as someone who is an advisor in trades is I'm a long-term investor at the end of the day. So some of this is noise, and as sort of a more Warren Buffett, secular long-term buyer of securities like stocks, in one sense, I'm ignoring this. But at the same time, I also am trying to look at the tea leaves to say, all right, well, I don't want to get egg completely on my face over the next year. I want to have a decent idea of where I believe the markets are going. If you ask my wife at the beginning of the year, I had a lot of anxiety and I was pretty stressed out about the markets, right? I'm watching client accounts decline. The tariffs were flying up. And I think at first I just thought, where are we going? Because the average tariff rate was only 2% under his first administration and was relatively benign. And then all of a sudden it's like giant reciprocal tariffs, a level across the board global tariff. We went from like 2 to 18% really quickly, if not higher at one point. And then they pivoted, and then I grew a lot more confident. Now, I made no knee-jerk reactions, and that's my protocol, as I don't make quick reactions when we see major policy changes because they are subject to change. Now we've seen this pivot, which happened a couple months after Liberation Day. Where do we go in your estimation as we move further into 2026? I know you're not a forecaster by trade, and I don't try to forecast either, but do you have a general sense of, do you think Trump will leave tariffs in place if we started to see a bear market creep up, or do you think the Scott Bessents are going to pull him back and say, hey, look, we probably need to be a little more accommodating at this point?
I think that first of all, I think that I don't think that a recession would force a reversal of course, right? Like,
okay,
in a recession, I would expect them to actually, just, I would more expect them to push on the gas pedal. Like, I would expect them to send people checks and, like, do whatever they can to try to get the economy to recover without changing the course of like their broader sort of policies. I do think that I do have some concern, and I do think the administration has some concern that a recession is on the horizon. Like, if you look at a lot of the employment data has not been good. And the employment data, and not only has the employment data not been good, but the revisions that we got, coming out of the Biden administration already illustrated that the labor market wasn't as healthy as we thought it was.
Mm-hmm.
And so I think
that was major. That was scandalous, frankly.
And so look, I don't even think this is political. I think like the Bureau of Labor Statistics, I think that their model is broken. Mm-hmm. I think that they make all these statistical adjustments to the data, and I think that post COVID those statistical adjustments seem systematically flawed. And so I don't even necessarily think it's political. Maybe it's political in the sense that it's sort of like stubbornness. I don't know, but like, but when you're systematically like overestimating the number of jobs, like there's an issue with what you're doing, like, because you're always going to make errors, but the errors should even out over time, and their errors were, accumulating over time. Mm-hmm. And that's and that's an issue. So I do think that there's weakness there. I do think that is something to be concerned about. I do think that the Trump administration. The interesting thing is about interest rates, right? So
I was going to bring that up.
Yeah, is that I do like to me there's two things going on here. I do think that the administration's push for the Federal Reserve to lower interest rates, I do think that reflects their belief that there is weakness in the economy, and that Fed needs to get in front of the weakness and not wait for it to show up, because once it shows up, then it's kind of too late.
Yeah, the Fed's always late.
But I also think the other thing is there is an interesting thing here about about interest rates. Interest payments on the debt are now the third largest outlay from the Treasury Department, greater than national defense.
Mm-hmm.
And the reason that this is important is that we're in a world, or at least we're potentially in a world, where fiscal policy starts to be the dominant factor. And so what I mean by that is like typically when we want to bring down inflation, we start raising interest rates. And by raising interest rates, you push the interest rate, higher than it would be in, like a free market. And what that does is, it starts to slow down economic activity. It puts downward pressure on prices, those kinds of things. But when you are in a world where like interest payments are your, third largest outlay, increasing interest rates is increasing those interest outlays, right? And the way that we finance our debt, this is another issue that Benson has talked about, is that the Treasury Department, essentially finances its debt, over 90-day periods, right? Like they're issuing 90-day T-bills and then just paying the interest and then reborrowing the principal. And when you do that, like you're putting yourself in a very difficult scenario because you're constantly having to borrow over and over and over again. You become very sensitive to interest rates. And so the interest costs can go up substantially when you're borrowing at such short terms. And one of the things that Benson has talked about is like, we not only need to get interest rates down to control these interest expenses, but once they get down, we need to like expand the duration of the debt. We need to be borrowing at like 10, 15, 30 years, right? And because then you're going to be less sensitive to sort of like the whims of the short-term market in terms of what your interest costs are and things like that. And you have a little bit more certainty about how much the interest cost is over a certain period of time. And I think that's kind of the concern, is like they're actually talking about this explicitly. Like this is normally a thing that only like economists kind of talk about, is like how, well, what's the dominant policy, monetary policy or fiscal policy? I mean, you see like Trump will just say this, like he'll be in a press gaggle and they'll say, oh, you're yelling at Powell. And he'll just say, interest rates have to be lower. The debt's too high. We're never going to be able to pay back this debt with interest rates like this. And it's like he's signaling to you, right, that they are concerned about the trajectory of the debt.
It's a really good point. Yeah. So to push back a little bit on maybe the problem, though, is one of the things that investors are very aware of and they experience in the lead up to say 2020 is that 30-year Treasury, 15-year Treasury notes were paying like very little, 2 to 3% yields to hold a security that long. And then the longer the duration of a security, the greater the interest rate sensitivity is, right? Yeah. And so when rates start going up, holders of long-term debt got burned. That's not that long ago. So one of the questions I have is, will the market drive rates low enough to satisfy somebody like Benson? Sure, you can theoretically drive rates down, but I wonder if that's going to drive rates down on the shorter end of the curve for short and intermediate term bonds. I think the longer end of the curve tends to be a teeny bit more market-driven than Fed-driven. And like, will they get those 15, 30-year treasuries down? Because you need a demand and an appetite and a market to go out and want those. And I know like sitting on a 3% 30-year treasury is relatively unappetizing, one, because the yield stinks, and two, now you've got, for every interest rate increase, if the Fed had to tighten again, for every interest rate increase, you've got a 30% downside. That's a multiplier, right? And so long-term bonds, like 2022 is that example. Holders of long-dated securities like 30-year treasury bonds, they got burned bad in 2022. The bond ag was down 13% in 2022. And so one question I have, and just throwing this out theoretically, is will the market actually drive longer-term debt down to a place where Benson would even find that appealing?
Well, I think there's two issues. Is they obviously want to borrow more cheaply, but also I think that they would like. I think that, so for example, if you told them that they could borrow at 2%, but that rates would fluctuate wildly afterwards, then I don't I don't think that they would be excited about that. Like, I think that they would gladly take a scenario where interest rates were like 3.5%, 4% and stable at the long end. Then
You're saying the buyer of the debt?
no, I mean, even Benson, I think, like, because what you're looking for is you're looking for people to be willing. You want these people holding these things long term, right? You don't just want people. You don't just want initial buyers, right? You want people holding these things long term to give you that more stability, because in theory you're going to be selling these 30-year bonds like every year, right? And so you need to have some kind of demand for that debt. I think the other thing is I think that they do think that people are going to be willing to take lower rates at the long end, because if we go back to our stablecoin conversation, if the stuff like that, really takes off, that's going to dramatically increase the demand for T-bills.
Good call.
And so T-bills are going to have much lower yields. And then at that point, that's going to push people out on duration, because they're trying to find yield.
Okay, last couple questions, and we'll wrap here. If we were to hit a recession in 2026, and I know you're not necessarily calling for it, you just think there's structural weakness that could lead to it. Is this, in your estimation, could this be a byproduct of trade barriers, or do you think there's some other sort of pre-Trump macroeconomic issue that's been sort of coming undone over time slowly?
Well, I mean, I think like that's actually the interesting question, because like one of the things that was going on in 2019 is like there were signs that maybe we were headed for a recession, but then we got this global pandemic, and then we had a quote unquote recession, which was, not really a recession. Like, we shut everything down and then we opened everything back up.
Yeah.
And so one thing I'm concerned about is like, to what extent was that real, and to what extent did those issues get resolved versus they just been masked by
stimulus?
Yeah, easy monetary and fiscal policy.
Yeah, totally.
That's one of my concerns. The other thing about trade is like, look, even if you think that the trade policy is a good idea, you have to acknowledge that there's going to be short-run costs associated.
Correct.
With it, because you can't just up and move a factory. You can't just like have a factory in the Philippines and like move it to South Carolina like, tomorrow. Like, that's not, it takes time. The other thing is that, the tariffs, because these are, in some sense, it makes sense to just have, tariffs on a particular country or something like that, rather than trying to make this, trying to get this incredibly complicated system where different goods in different countries and all this other sort of stuff is like, you don't want to make it so that the administrative costs of the tariffs are so high that like you're not really getting any benefit. So having simple tariffs reduces those administrative costs. At the same time, however, right, like that also makes them a blunt instrument. And so one of the issues here is that most of the time, like when we're talking about trade, especially like in textbooks or casual conversation, we're thinking of trade only on like consumer goods. But it's not only on consumer goods.
Inputs.
It's on inputs. And so those inputs to production, like this, number one, what this is going to do is this is either going to...
It's 50% of all imports. Sorry to cut you off, but it is 50% of all imports are inputs.
Yeah, and so that is going to do one of two things. That's either going to squeeze profit margins, or it's going to lead to higher prices, or some combination thereof. Now, it's not higher inflation, it's higher prices, right? Like you would expect these to be like one-time adjustments, not continuous adjustments. But the point is, right, is that if it's squeezing profit margins, then that's going to tend to reduce investment, right? If it's increasing prices, that's going to tend to reduce consumption. And so either way, you're going to get kind of a reduction in economic activity. And then also the sort of reallocation effects, right? Because people don't, business owners don't just sit around and go, oh no, my input costs went up. Like, I'm so screwed. No, like they look for solutions to that problem, right? They try to figure out how to cut costs elsewhere, or try to find a new input supplier or whatever. But the thing is that in the long run, that might produce the benefits that the administration desires. But in the short run, there's going to be a lot of costs there, because you're sort of having to reallocate resources. You're having to try to find other things that you can cut. And so, I do think that we should expect, some economic costs from them. Now, whether that throws us into a recession or not, I don't know.
It's so hard to know.
Yeah.
And there's always the other side of the scale where we have incredible innovation happening with AI, and undeniable the productivity gains that we're seeing from that. And I think what's one of the hard tasks of an economist, particularly someone that works in forecasting, is that you can look at, a lot of times I find economists and even a lot of laymen, they only look at sort of so if it was like a balance sheet of a corporation, it's like they always look at the debt side. They always look at the cost side. They don't really ever look at the tangible asset side or the cash flow side, right? And so I guess looking at the cash flow side of the business or the opportunity, we are seeing significant gains. I am personally experiencing it with the use of AI in terms of saving in my own practice hundreds of hours a year and time that was spent on menial tasks. And I do believe, and I'm quoting the chief economist for Raymond James Investment Management, that based on his analysis, it's turning into like an exoskeleton to the U.S. worker, right? So in a vacuum, I could see these policies, Josh, leading us into a recession. But we don't live in a vacuum, and that's what makes the job of an economist, I think, fun and dynamic, is that the world's never like a giant Keynesian equation. It's actually a little bit more dynamic than that. And there's real world reality where maybe we have a lot of bad policies that come out from the White House, or we have a lot of, and even if they're not bad policies, they just have short-term costs of those policies, or from the Federal Reserve, or from Congress. But what about the other side of the balance of scales, where there could be a great growth of innovation and productivity that offsets those costs? So that's what makes this game very difficult. So if you're listening to this and you're an investor, what I'm not saying, I don't think you're saying either, Josh, is this is definitely leading us to a recession, but it's a balance of scales. How do you feel about that?
No, I think that's right. I mean, I think like in the short run, the policy is going to create some headwinds for the economy. The question is like, how strong are those headwinds, and sort of like what was your speed before you hit that headwind, right? So yeah, you've got these countervailing forces that could potentially offset, those costs, and then that's the other thing too, is that the thing that a lot of times the thing that people forget is like all of these businesses, like they're very dynamic, right? Mm-hmm. Like the they're very resilient, right? Like this is why, I mean, sort of by definition, right? Like the companies that don't last very long, and the companies that do, survive. And so those companies that are surviving, right? They're good at adapting. They're good at figuring out solutions to problems. They're good at trying to minimize the damage of like unexpected costs and all these kinds of things. And so, we also have to kind of keep that in the backs of our heads, when we're sort of thinking about these things as well.
Awesome. Josh, this is a very enlightening conversation. Really appreciate you coming on today.
Yeah, no problem.
If you've enjoyed this content and you're looking for a wealth advisor, or if you're a financial advisor and you're looking to make the jump to the independent side, please message me on LinkedIn, or you can email me at drew.benson@bensonwealthmgt.com. Or lastly, you can call my office at 603-316-2544. Securities offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Benson Wealth Management and True North Wealth Management Group are not registered broker-dealers, and they are independent of Raymond James Financial Services. The foregoing information has been obtained from sources considered to be reliable, but we do not guarantee that it is accurate or complete. It is not a statement of all available data necessary for making an investment decision, and it does not constitute a recommendation. Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. There is no guarantee that these statements, opinions, or forecasts provided herein will prove to be correct. Investing involves risks, and you may incur a profit or loss regardless of strategy selected.